Welcome, aware, and dumalang, molo, soubona, ukandat, and a warm welcome to the Indufo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're going deep, into the world of accounting standards, specifically IAS 2, the international standard that guides companies on how they report their inventories. So think of it like this. If you're running a business from a bustling spaza shop in Soweto to a massive car factory in Uitenhage, IAS 2 helps you keep track of everything you have ready to sell and how you report its value to the world.
People often hear accounting standards and their eyes kind of glaze over, but IAS 2, it's far more exciting than it sounds. Think of it like a detective novel, where we're uncovering clues hidden within a company's financial statements. And these clues can tell us how well a company is managing its inventory, which has a big impact on their bottom line.
Okay, you've convinced me. IAS 2 sounds pretty interesting. Why is this standard such a big deal? Is it really that important for companies to be following these rules?
Absolutely. Without a common set of rules, comparing companies would be like trying to judge a rugby match, where each team is playing by its own made-up rules. It would be chaos. IAS 2 levels the playing field, making sure everyone is following the same playbook. This makes it much easier for investors, analysts, and even everyday people like you and me to understand a company's financial performance and compare apples to apples, or should I say borrowers to borrowers.
Borrowers to borrowers, I like it. So what's the main principle behind IAS 2? Is it all about meticulous stock taking and, endless spreadsheets?
Well, there are spreadsheets involved, but at the heart of IAS 2, there's a core principle. Inventories are measured at the lower of cost and net realizable value. And that might sound a little complicated, but let me break it down. Cost is essentially every rand and cent the company has spent to get those goods ready to sell. We're talking purchase price, shipping, even some of the costs involved in manufacturing or prepping the product.
So it's not just about the sticker price. There are hidden costs lurking behind those products on the shelves.
Precisely. And here's where it gets even more interesting. Net realizable value, or NRV, is what the company realistically expects to receive from selling those goods, minus any additional costs like marketing or delivery. IAS 2 is all about being cautious and realistic. If a company realizes their inventory is worth less than they paid for it, or if they don't think they can sell it for as much as they initially planned, they need to adjust the value downwards.
It sounds like it could be a blow to a company's profits.
It can be. And that's why IAS 2 is all about transparency. It ensures that companies are presenting a true and fair view of their financial position, not trying to sweep any potential problems under the rug. Remember, investors and stakeholders need accurate information to make informed decisions.
Okay, so IAS 2 is like a financial watchdog, making sure companies are playing by the rules and reporting their inventory value honestly. But how do they actually calculate the cost of their inventory?
Yeah.
It can't be as simple as just adding up receipts.
You're right, it's far more nuanced than that. Remember those purchase costs, conversion costs, and other costs we talked about. Each of these categories has its own set of rules and considerations under IAS 2. Let's break it down further.
Sounds good. Tell me more about these cost components.
Okay, imagine you're a clothing retailer importing fabrics from China. Your purchase costs would include the price you paid for the fabric, but it doesn't stop there. You also need to factor in import duties, transport costs from the harbor, handling fees at the warehouse, and any other costs directly related to getting those fabrics ready for sale.
So it's like a whole logistical journey just to get those materials, and every step adds to the final cost.
Exactly. And things get even more complex when you consider conversion costs. Think of a company like Distell producing their famous Amarula cream liqueur. Their conversion costs would include the labor costs of their workers, the cost of running those massive distilling and bottling machines, and even a portion of the electricity bill for the entire factory.
Wow, it's almost like every drop of Amarula carries the weight of all those costs. But what about those costs that aren't directly related to making or buying the product? Things like administrative expenses, marketing campaigns, or even the cost of running the head office.
That's a crucial point. IAS 2 is very specific about what costs can be included in inventory valuation: general administrative costs, marketing expenses, and storage costs. Unless they are necessary for the production process, are not considered part of the inventory cost, these costs are treated as expenses in the period they occur, separate from the inventory valuation.
So IAS 2 draws a clear line, helping companies distinguish between the costs that are genuinely part of the inventory and those that are simply part of running the business.
This is making me think about my own shoe collection. Maybe I need to do a deep dive into my shoe collection and figure out the true cost of each pair.
That might be an eye-opening exercise, but this clear distinction is vital to prevent companies from artificially inflating their inventory value. By lumping in unrelated expenses, makes sense. Okay, so we've explored purchase costs, conversion costs, and ruled out those sneaky unrelated expenses. But how do companies actually put all this information together to calculate their final inventory value? Do they just pick a method at random, or is there a system?
That's where those fascinating cost formulas come in. ILS2 allows companies to choose between different methods, and each method has a different impact on how inventory is valued and ultimately reported in their financial statements.
So it's not just throwing all those costs into a pot and stirring.
Nope.
Tell me more about these different formulas.
The two most common methods are FIFO, which stands for first in, first out, and the weighted average cost method. Imagine our spaza shop owner stocking up on those ice-cold cool drinks.
Hmm.
If they use FIFO, they're essentially assuming that they're selling the oldest drinks in their fridge first. So the cost of those older drinks is what gets matched against their revenue.
That makes sense. So with FIFO, if prices are rising, the company would be reporting a lower cost of goods sold, leading to a higher profit, right?
Precisely. And conversely, if prices are falling, FIFO would result in a higher cost of goods sold and a lower profit. Now, the weighted average method works a bit differently. Our spaza shop owner would calculate an average cost for all the cool drinks in stock, regardless of when they were purchased. This smooths out the impact of those price fluctuations, providing a more stable picture of inventory cost over time.
So it's like choosing between a bumpy ride and a smoother journey. But can companies switch between these methods whenever they feel like it?
Not so fast. IAS2 requires consistency. Companies have to pick a method and stick with it for similar types of inventory. This ensures that their financial reporting is comparable across different periods and prevents them from, playing games with their numbers to make things look better than they actually are.
So consistency is key. Just like when you're buying Bar Wars, you can't keep changing the heat. You'll end up with some unhappy customers.
Absolutely. A consistent approach to these cost formulas ensures fair play and gives everyone a reliable view of the company's inventory position. But what happens when things go wrong? What if some of that inventory gets damaged, becomes outdated, or suddenly loses its value? Well, that's a whole other kettle of fish, or should I say pot of bunny chow. That we'll explore in the next part of our deep dive into IAS2. Even with the most meticulous planning and those carefully chosen cost formulas, the business world can throw some curveballs. It's like trying to predict the weather in Cape Town. Sometimes those sunny skies can turn into a torrential downpour in a matter of minutes.
Absolutely, you can have the best Boer words and the hottest coals, but if load shedding hits right when your guests arrive, you've got a catastrophe on your hands. So what happens in the business world when those unexpected events affect a company's inventory?
Well, that's where the concept of net realizable value, or NRV, comes into play. Remember, IAS2 is all about being prudent and realistic. It's like that wise old uncle who always tells you to save for a rainy day. If something happens that makes the inventory less valuable, the company has to face the music and adjust the value downwards, even if they haven't sold the goods yet.
Okay, what kind of situations would trigger this NRV adjustment?
Imagine a shipment of Rooibos tea bags gets damaged in a truck accident on the N1. Or a furniture store finds their latest range is suddenly out of fashion because, trends change faster than a taxi driver switching lanes in rush hour. Or maybe the price of a key commodity like platinum drops faster than a springbok winger diving for a try.
Ouch, those are some vivid and painful examples. So if the NRV dips lower than what the company initially paid for the inventory, or what they thought they could sell it for, what happens next?
That's when the company has to do what's called a write-down. They reduce the value of the inventory on their books to reflect the new lower NRV. And guess what? This write-down directly impacts their profits, like a pothole on the road to financial success.
So that's how IAS2 keeps companies honest, or at least financially grounded. It forces them to acknowledge reality and reflect the true value of their assets even when it hurts.
Exactly. Transparency is key. Investors and other stakeholders need a clear and accurate picture of the company's financial health. No one wants to be caught holding shares in a company that's pretending everything is rosy, when their stock is wilting like a forgotten pot plant.
I see. So this NRV concept seems pretty straightforward, but I imagine it can get a bit tricky when it comes to actually calculating it. How do companies figure out the NRV of their inventory? Do they just throw darts at a board and hope for the best?
Thankfully, IAS2 provides some guidance. Companies are required to use the most reliable evidence available to estimate the NRV. It's like a detective gathering clues. This evidence might include current market prices for similar goods, recent sales data from their competitors, or even professional valuations from industry experts. The key is to use good judgment. Be realistic and back up those estimates with solid data.
So it's a bit like those property shows, where they estimate the value of a house based on recent sales in the area.
That's a great analogy. It's all about using data, market insights, and a healthy dose of common sense to arrive at a reasonable and justifiable NRV. And remember, this NRV assessment is an ongoing process. Just because the NRV dipped at one point doesn't mean it will stay down forever. The market can be fickle, just like the supporters at a Chiefs versus Pirates game.
So there's hope for those damaged tea bags and out-of-fashion furniture. If the market picks up or they find a creative way to sell those items, they can adjust the NRV upwards again.
You got it. IAS2 allows for what are called write-down reversals. It's like getting a second chance. If the situation improves and the NRV bounces back, companies can reverse that write-down, but only up to the original cost. It's a bit like making sure those borers don't get burned after load shedding. You adjust the heat and give them a chance to cook evenly.
So it's all about balance.
Exactly. IAS2 is all about finding that sweet spot between prudence and flexibility. You know, we've covered a lot of ground here, from the intricacies of cost calculation to the twists and turns of NRV adjustments. But IAS2 doesn't stop at telling companies how to measure inventory. It also shines a light on the importance of transparency, requiring companies to disclose key information in their financial statements. Think of it like opening up the kitchen in a restaurant so diners can see the chefs at work.
Now that's an analogy I can get behind. Transparency builds trust, whether it's in a restaurant or a company's financial reporting. So what kind of information does IAS2 require companies to disclose?
Well, for starters, they need to reveal the accounting policies they've used for their inventory valuation. This includes those cost formulas we discussed earlier. Whether it's FIFO, weighted average, or another method, they also have to disclose the carrying amount of their inventory, which is basically the total value of their inventory at a specific point in time. It's like providing a snapshot of what's on their shelves, but in monetary terms.
So it's like giving investors a detailed recipe for how they arrived at that final inventory number on the balance sheet.
Exactly. And it doesn't stop there. IAS2 also requires companies to be upfront about any write-downs or reversals they've made. This helps investors understand if the company has had to adjust their inventory value downwards due to those unexpected events we discussed earlier, and whether they've been able to bounce back and recover any of those losses.
Okay, so it's a glimpse into the company's past performance, revealing how they've managed their inventory.
You got it. And to add another layer of transparency, companies also have to disclose if they've pledged any of their inventory as security for loans. This is like putting up your car as collateral when you take out a loan. It's important information for investors because it shows them if the company has used its inventory to secure financing, which could put those assets at risk if things go south.
So IAS2 is like shining a light on every corner of the business.
That's the beauty of well-designed accounting standards. They bring clarity, consistency, and a healthy dose of accountability to financial reporting, making it easier for everyone to understand what's really happening behind those balance sheet numbers.
Wow, this deep dive into IAS2 has been truly enlightening. Who knew that valuing inventory could be so intricate and have such a significant impact on a company's financial story?
It's definitely more than just counting boxes and updating spreadsheets.
For sure. We've unraveled the complexities of cost calculation, explored the pros and cons of different cost formulas, and navigated the ups and downs of NRV adjustments. And we even peeked behind the curtain of mandatory disclosures, all with some great South African analogies along the way.
But before we wrap up this episode, I have a question for our listeners. We've talked extensively about how IAS2 applies to companies, but what about individuals? How might the principles of IAS2, those concepts of cost, net realizable value, and transparency, apply to your own personal finances?
That's a great question. It's like applying those inventory valuation principles to our own inventory of assets, whether they're cars or houses or even those shoe collections we talked about earlier.
Precisely. It's about being mindful of the value of our assets, understanding how that value can fluctuate over time, and making informed decisions about buying, selling, or holding on to those assets. It's like a mini IAS2 for our personal lives.
I love that. I'm definitely going to be thinking about that next time I reorganize my closet.
It's amazing how these accounting principles can have such broad applicability.
Absolutely. This has been an insightful deep dive into IAS2 on Dubo Knowledge Cast. But hold on to your calculators, because we still have one more part of this journey to explore. We'll be tackling the crucial topic of disclosures and looking at how IAS2 impacts the big picture of financial reporting. Until then, sharp, sharp. Welcome back to Induvo KnowledgeCast. We've been on quite a journey exploring IAS2, unpacking its impact on company financials, and even, reflecting on its relevance to our own personal lives.
It's been fascinating, hasn't it? We've covered a lot of ground. From the nitty-gritty of cost calculation to the importance of net realizable value and those insightful disclosures that give us a peek behind the curtain.
As we wrap up this episode, I'm thinking about the bigger picture. What does it all really mean for businesses, investors, and the overall economy?
That's a great question. The key takeaway is that IAS2 plays a vital role in ensuring transparency and comparability in financial reporting. It's like a common language that allows everyone, from seasoned investors to everyday consumers, to understand the financial health of companies and make informed decisions.
So it's about making sure everyone has access to the same information.
Exactly. Imagine trying to compare the performance of two companies, one following IAS2 and the other using their own set of rules. It would be like trying to have a conversation where each person is speaking a different language. IAS2 helps to bridge that gap, fostering trust and confidence in the financial markets.
And that trust is crucial, especially in an economy like ours here in South Africa.
Absolutely. Investors need to feel confident that the information they're using is reliable. IAS2 creates that level playing field, allowing investors to make informed decisions about where to allocate their capital. This drives economic growth and supports the development of a healthy business environment.
So it's like building a solid foundation for our economy. But let's be honest, accounting standards can sometimes be a bit dry. How do we make this topic more engaging, especially for young South Africans who might be considering a career in accounting?
I think it's all about showcasing the real-world impact of accounting. It goes beyond just numbers, whether it's promoting sustainable business practices, supporting entrepreneurship, or even helping to build a more inclusive economy. Accounting plays a crucial role.
So it's about telling the story behind the numbers.
Exactly. We need to break down those stereotypes and show young people that accounting is a dynamic and evolving field, filled with opportunities to make a real difference. It's not just about crunching numbers, it's about being at the forefront of business innovation, driving decision-making, and shaping the future of our economy.
It's like being a detective, uncovering insights and helping businesses thrive.
And let's not forget the tech aspect. Accounting is increasingly intertwined with technology, with cloud-based software, automation tools, and data analytics transforming the profession.
It's definitely not your grandfather's accounting anymore.
So to all those young South Africans out there considering a career in accounting, I say go for it. It's a field that offers intellectual stimulation, practical skills, and the chance to make a real impact.
It's both challenging and rewarding, requiring analytical thinking, problem-solving skills, and a passion for business. And who knows, maybe you'll be the one explaining IAS2 to a new generation of listeners right here on Induvo KnowledgeCast.
I'd love to see that. But for now, this has been our deep dive into IAS2 on Induvo KnowledgeCast. We've explored its core principles, its real-world applications, and its significance in the broader economic landscape. Hopefully, we've sparked some curiosity about the world of accounting.
Until next time when we delve into another topic, remember to stay curious and keep learning. Sharp, sharp.